Turn gold and silver into monthly income? Is that possible? Well, we're going to show you 3 funds that actually pay out monthly, are built around gold and silver. Will this be good for your retirement account? Well, we're going to explain it all to you today.
Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy. Most investors think of gold and silver as non-income assets. You buy it for inflationary protection, you buy it for currency hedging, portfolio insurance, but not for cash flow. But what if we could turn gold and silver exposure into monthly income? Today I'm breaking down 2 newer funds from Kurvs and one from Neos that do exactly what I'm talking about. We're going to show you how these funds actually work, where the income comes from, the risk for investors, and who the ETFs may or may not be for. We're going to show you that this is probably a good position to be into in a retirement package as more of a secure base. If you know my 3 bucket system, kind of bucket A, that protects your total package but generates income. Let's get into today's video. And before I do, I got to do a shout out to all of our Patreon supporters. Thank you so much. It means so much to us that you're supporting and helping the channel grow. Also, all the YouTube members, thank you for your contributions. And if you're not a subscriber, don't be afraid. Hit that subscribe button, hit that bell notification. We'd love you to have part of the family. Let's get into today's video.
Hey, we have to do the disclaimer, and it's this. This is for educational purposes only. I am not a financial advisor. If you need financial advice, always contact a financial advisor. And the information given here is for entertainment purposes only and hopefully give you some educational to work from. So the dead money problem. Traditional income assets, dividends, regular payments from company profits, earnings generated from business operations, and cash flow is income from investments. Gold and silver, on the other hand, there are no dividends, so they're not regular payments. There's no earnings, it's not a business. It's no cash flow, it's not income. What they are, they're commodities that people buy and they sell. You buy and you sell. You hope the commodity goes up, so when you sell, you make some extra money from it. The traditional use for this is inflation hedging, currency protection, and portfolio diversification. But historically, you own metals for pieces of appreciation only. And these ETFs we're going to talk about today are changing all that, and they're making some big inroads. So how do these ETFs create the income? Well, they got the metal holdings from physical gold to silver exposure. They're selling call options, obligating the delivery of the metal at the strike price. They're collecting premiums for those options, and they're paying it out in monthly distributions. So the optional strategy sells call options against those metal holdings. They collect those premium incomes, distribute it, send it out monthly to the shareholders. Now, income comes from volatility, not the metal value. That's a big difference here. You got to understand. It's about income comes from the volatility of the market. Investors pay premium for upside exposure, and ETFs capture the cost as income. This is not speculation. This is income engineering, a deliberate strategy to convert metal exposure into cash flow. The first fund we're going to look at is this comes from Kurv's Gold Enhanced Income ETF. The Kurv Enhanced Income ETF is an exchange traded fund that mostly invests in gold commodities. The fund is actively managed and it's seeking to maximize total return through investments in gold, gold bullion, and related EPSs, derivatives, and fixed income securities. The fund aims to outperform physical gold. So the Spider Gold Mini Shares Trust, it generates consistent monthly income from gold exposure. The strengths of the fund, it's tied directly to gold price behavior. So if gold's going up, this should go up. Gold's going down, this is going to go down. The performance best in flat and range-bound gold markets. And that income profile for predictability distributions. And the trade-off, the upside is capped during gold rallies. And this is why you won't see KGLD as high up as gold is, because of the cap of those option strategies. NAV may linger during strong bull markets in gold. The best use case is income-focused investors who want gold exposure without relying on price appreciation alone. Most suitable for investors prioritizing for stability over yield. When we pop the hood on this one, you will see KGLD from Kurv is $68 million in assets. Their expense ratio is a little high at 1%. They have 1.97 million shares outstanding. Now, this fund started in July 8th of 2025. So looking at the dividend and dividend yields are going to be a little off because it's paid $1.70 so far, or 4.77% since July. It pays out monthly. Now, Kurv puts out their dividend yield at 11.59%. But look at the fund growth. The fund growth already at 45.27%. 1 year total return. Now, it has not been out a year, so remember, they're forecasting this out. 1 year total return, 54.28%. Year to date, so that's going for 26 days of January, already up 18.91% total return. In September, it had a price increase from 25 cents to 30 cents in its distribution, and it's paid out 30 cents across the board. This is what we see from the fund: steady dividend income, but the appreciation of the gold has taken the fund tremendously higher. So you're getting the best of both worlds, of great growth and solid dividends. So why we say this is a good fund is because of the standard dividend payout that it's been. Now, it's barely new, so we don't know how it's going to continue to perfect with gold running like it is. The next one is IAUI, the NEOS Gold High Income ETF. Now, this fund here, again, is an ETF, exchange-traded fund, and mostly invests in gold commodities. The fund is actively managed, seeking monthly income by investing in gold ETPs, combined with a synthetic option and covered call strategies. Now, this one's going to use a multi-layer strategy. It's going to use a gold link instruments exposed to gold futures and gold-backed securities. Its inflation and sensitivity assets, allocation to equities and fixed income securities that perform well during inflation, and option-based income, the sale of call options on underlying assets to generate premium income. The key differentiator of this is inflation alignment. Performs well when the inflation is dominating the economy theme. Benefits from increased market volatility during inflation spikes and capitalizes on higher option premiums due to uncertainty in the real interest rate markets. The independence from spot on gold can deliver income even when gold prices are stagnant or declining. It provides that inflationary pressure and volatility remains elevated. Looking at the hood of this one's been out since June 5th, but you can see a lot more excitement in the NEOS fund because there's over $336 million already invested into it. Expense ratio more in line at 0.78%. 5.59 million shares outstanding. Their dividend yield and dividend payout definitely higher at $4.46 and 7.30% respectively. It does pay out monthly. And like I said, this came out June 5th, so we don't have a full year under its belt. The dividend yield of reported 12.53%. The growth of the fund, again, not as big as the Kurvs, but 21.76%. Total return, though, 81.95% since inception, and year to date 17.26. I put the year to date on there because of it being January. So of course, these numbers will change day in, day out, hour by hour, and so on. But you can see that they are affected by the pricing of gold as well, dramatically increasing and moving up very quickly. Distributions, they're paying out a bigger distribution over their period of time. So they are getting more cycling through on their options trading. Now let's turn to silver. And this comes Kurv, KSLV. It's the silver income focus. Kurv leverages silver's unique characteristics to generate higher income potential through option strategies. Now, silver always shows a more price fluctuations than gold. It's creating more opportunities for income generation. The industry demands silver's dual role as a precious metal and an industrial commodity creates a unique market dynamics. Larger price swings of leading to higher option premiums and increased income potential. So the income generation mechanisms, the higher the volatility, the higher the option premiums. The larger the premiums, the higher potential income. So the fund is really used in both factors. It's a higher risk profile, and it also has a moderate NAV stability. The technical income from silver with acceptance of the higher volatility. Now, this is not suitable for what we always call a set and forget type investors. You do need to keep an eye onto it, because if silver pricing drops dramatically, you're going to see a dramatic drop in NAV and NAV erosion across the board. But silver's been playing. China's a big part of the silver story. They're not going to be releasing as much silver out there into the marketplace because they need it for their manufacturing. We look at the underneath the hood. Now, this is something new. Silver is really starting to take a bigger hit or a bigger commodity out there since gold has gotten so high. Silver's starting to now come into play. There's not a lot of players in this market, but look at $87 million under assets. Again, that 1% expense ratio, 1.85 million shares. And when we get to it, again, September 29, so very, very short period of time. So I'll go to the dividend yield. 18.52 is the forecasted number out. The fund growth, though, 116.24%. So it's been rocketing since the beginning of the year. So 1 year total, they're at 130.99%. And year to date, which is just January, 55.06%. Their distributions, you can see those things are really starting to climb up by basically 20 cents in this past distribution. So the key comparison is snapshots of the three funds. The K Gold, which is from Kurv, gives you the gold exposure. The K Silver gives you the silver exposure. And IAUI is the inflationary gold link. Volatility, the gold, very low. Silver, very high. And then you have a moderate one. So you have a high, low, and medium. And then stable income, higher income, and a balanced approach. So each one of them has their own particular reason for being into a portfolio. So a question was, will this work for a retirement income integration? And I believe seriously that these things are your core portfolio, which is your bonds, your dividend equities, and annuities. I think gold plays very well into a part of a retirement package as a stable type fund, but also an income generator. The satellite role, a small target position that enhances your income. It gives you more diversification, adding non-correlated income from precious metals. It gives you an inflation hedge, income layers that keeps the pace with rising prices, and market resilience. That's why the big pieces of it comes together and saying, yeah, this is a critical piece that you could have part in your portfolio. Now, the critical mistake that I see a lot of people starting to try to use this stuff is treating these ETFs as safe yield investments. Unlike bonds or dividend stocks, They offer no principal protection. Okay, we have nothing to work from other than the price of the precious commodity that they're built around. So you got to make sure that these things are not that safety yield you may think of. Oh, I'm always going to get this money coming in, blah, blah, blah. Is you got to make sure that this goes into your portfolio as a separate leg of your table. The critical risk factors that we need to talk about, though, is income volatility. Distributions fluctuate based on the option premiums and market conditions. We can see decreases or suspend during periods of low volatility. Now, NAV erosion is a big thing here. Now, we can see everything's having huge growth, but if the gold and the silver plateau or something happens where they start losing their value, you definitely can see some big NAV erosion, especially when you're dealing with covered call strategies. Capping the upside, 100% from the call options, are going to cap the upside that your fund will actually gather from what gold or silver will actually do. Now, every one of these funds are actually registered and using return of capital. Now, I'm going to call that the double-edged sword. Return of capital is great for tax purposes, but it also is used that they can keep their distributions fairly maintained, but they're returning your capital, which is exactly what the wording is for. So it kind of reduces the fund's capital base if things change across the board. These funds require realistic expectations and active monitoring, and again, they're not suitable for that set and forget investor. So the optimal market conditions is really sideways or range-bound performances. And that is the best performance for high option premiums, that consistent income potential with the regular premium collections, and low NAV erosion ability. Now, the strong trending underperformance, capping the upside of those call options, the income volatility, and the NAV exposure to metal declines could impact the value. Well, there's a lot of things to it, and the key market insights: elevated volatility. Higher volatility equals higher option premiums, which includes better income. The range-bound markets, the price stability allows consistent premium collections. And the bullish conditions, strong rallies limit income potential from capped upsides. And that's what we're seeing right now, is that we're in a very bullish side for metals and for silver. And silver, like I said, has that differential. They're using it in manufacturing, but they're also using it as that commodity of income. So the core trade-offs between the two, is growth potential, full participation in metal price appreciation versus income consistency. What is that you're looking for? If you just want growth, yeah, go ahead and buy a piece of metal and put it in your safe and be done with it. But if you want income consistency with that potential also growth, then these ETFs really fall into line. So realistically, the key takeaways of this: income transformation. Gold and silver now generate monthly income through those option-based ETFs. The volatility income comes from the market volatility, not the metal itself, not the earnings. So they're creating those volatility part of it. So the three funds that I talked about offer different metal income strategies. And that's why we have the high, the medium, and the low for volatility and for risk. And the strategic trade-offs, capping the upside potential for that consistent income. The successful formula is realistic expectations, risk awareness, and strategic planning. Your trading growth potential for income is the consistency. Tell me what you think. Do you think these funds are something that you want in your retirement fund? Are these things have you even thought about? Have you been told to get into gold, but you think you got to go buy pure gold? Well, there's a way of getting income and security from those markets, and these three are giving you an opportunity. Let me know what you think in the comments below.